everybody and welcome to this video on understanding why is treasury function so critical in a bank. This YouTube channel is dedicated to learning concepts in banking, investment banking, hedge funds, OTC derivatives. So let's see more. Revenue is vanity. You've heard this phrase before, right? Revenue is vanity. Companies take pride in revenue. Profit is sanity. Revenue is vanity. Profit is sanity, but cash is king. This is often a phrase used by treasurers, CFOs, and bank managers to explain why organizations have to remain profitable. So if we get revenues, you gotta get profits, but at the end of the day, understanding the management of both of them along with the timing of every expense and cash flows ensures that cash will always be king. This video is broken down into 4 different sections. So let's understand what is the need for the first concept. What is the concept of treasury management? The second one looks at what is the need. And the third understands what is the requirement. Treasury management, a concept which is very common in many organizations, okay? But in banks, it assumes a significant importance because it helps manage the liquidity of the bank. So what do we mean by liquidity? Liquidity is a concept that is of utmost importance. In finance, it means the ability to meet contractual payments on time. Okay, so the dimension of time over here is very, very critical. Okay, you make contractual payments, right? But that if it is not timely, if it is not done on time, then you might be facing a liquidity problem. You might be facing a funding problem. So the ability to meet contractual payments on time is the definition of liquidity. Okay, facing a liquidity crunch means not being able to pay the contractual amount on time. So the time dimension is a complete essence over here. You've seen bankruptcies of large airlines, facing inability to meet contractual payments on time and thus being forced into bankruptcy and liquidation. Liquidity itself is classified by treasurers into 2 time dimensions. The first one is short-term liquidity. Short-term liquidity refers to any kind of contractual payment which is within 1 year. Okay, some banks put it into buckets of 30-day maturity, 60-day maturity, 90-day maturity. So they have a complete grasp of understanding what is the short-term liquidity. Long-term liquidity is the liquidity that is beyond 1 year. Some banks also bring into picture a medium-term liquidity, which is anywhere between 1 to 3 years. And since banks normally do not take exposures beyond 5 years, long-term liquidity is defined as that beyond 3 years. But this varies from bank to banks. But broadly speaking, if you look at short-term liquidity and long-term liquidity, both of them are literally intertwined like a bicycle, okay? For example, chronic short-term liquidity problems could result into long-term liquidity problems. The ability to diffuse and reduce short-term liquidity problems ensures continuity over the long term as well. The second concept that we spoke about in the pie diagram is a need for treasury management. Banks are dealing with investors, depositors' money, okay? Depositors have invested their lifetime savings with the bank. Therefore, banks have a critical element of understanding the need to meet depositors' money. But banks are paying interest on that. So they also have to invest the depositors' money in profitable assets and ensure that profitable assets have a mixture of both profitability as well as liquidity. The treasury takes care of that. The need for treasury management in a bank is extremely critical because they are managing the 3 requirements of profitability, liquidity and safety, as well as safety of the funds of the Banks' funds are invested in loans of different maturities. Okay, these loans could be loans to corporates or investment even in treasury bills, which are in short-term government treasury bills, or long-term government bonds, also called as GSECs or treasury bonds. So the bank funds that the bank has managed to raise is invested in a profile that is completely varying across maturities, because they have to manage the time cash flows. Okay, the timed cash flows is extremely critical. Therefore, banks spend a lot of time in analyzing and investing this money in assets which meet not only the liquidity profile, also the credit profile of the investee or the credit profile of the borrower, because they have to manage the three requirements of profitability, as well as liquidity and safety of depositors' funds. Bank funding also comes from bond issuances and deposits which are of varying maturities. In finance, we normally say short-term assets have to be funded by short-term liabilities, long-term assets have to be funded by long-term liabilities. There could be huge problems of refinancing and repricing if there is a mismatch between short-term assets and long-term liabilities, which will of course happen, right? And long-term assets being funded by short-term liabilities. So in order to prevent this chronic mismatch that could happen in balance sheets literally on a daily basis of the bank, the treasurer must address the matching of the two of them. This maturity profiling has to be matched. That is, short-term assets have to be funded by short-term liabilities as far as possible. Long-term assets have to be funded by long-term liabilities as far as possible. Also in the bucket. So matching the volume or the quantity is also very, very critical. Not just the timing, but also the quantity that has to be invested. The assets also have to be profitable, right? It cannot be that we are investing only in government securities which are giving low yield. They also have to be invested in corporate paper or subscription to corporate bonds, etc., so that the bank is able to generate sufficient returns for running not only its operations but also giving returns to the shareholders. The money is also to be liquid. Okay, so that they can meet depositors' requirements on literally a daily basis, right? I mean, and depositors who put money into savings accounts have to be able to withdraw their money on a daily basis. So liquidity is one of those challenges that is there. Who is responsible for treasury management? Normally, the responsibility for treasury management falls on what is called as the treasury division of a bank, which manages trading in two unique asset classes. One is foreign exchange and the other is obviously the bonds and the money market division. The bonds and the money market division, also called as the markets division, is responsible for managing the liquidity of the bank. Along with, of course, support from the risk division, the money markets division and the bonds division, the fixed income division, is responsible for managing the liquidity of the bank. They're responsible to decide whether to invest in a 5-year bond, a 7-year bond, a 30-year government bond, etc., because they have to clearly be able to manage the liquidity for buying up such long-term assets. So markets division is normally responsible for this aspect of it. Who are the stakeholders for treasury management? The stakeholders are so many for treasury management, because if the liquidity of the bank fails, and liquidity failure could arise because of poor credit risk, market risk principles not being followed, as well as prices being very topsy-turvy, many defaulters coming in, banks might find themselves choked up with requirements of cash and liquidity, right? They might have liquidity, but they may not be able to source it at the right time. This depends upon the central bank's monetary policy. If the central bank's monetary policy is easy, then they're able to source liquidity at liquid funds at lower costs compared to otherwise. But that is too dependent a variable, right? And hence cannot be managed always. So the stakeholders would largely include the depositors who have trusted the bank with their lifetime savings. It involves shareholders who have invested capital into the bank, right? I mean, they also are looking for profits. Depositors are looking for interest as well as safety of the deposits. Shareholders are looking for interest. The bank itself, they need to pay salaries, they need to run their operations, they need to give high bonuses to their dealing room, etc. So they are also responsible for they also have a big stakeholder in the liquidity of the bank. Regulators are constantly monitoring the liquidity of the bank, because if the bank gets illiquid, then it could result into a problem for the depositors. Thank you so much for watching this video. If you like the content, like, share, subscribe, and watch more of this content.